First step is to determine what structure that business will take. There are three basic structures, and each have their strengths and weaknesses. Proprietorships are a very basic, very simple business structure. The income from a proprietorship is reported on the individual's personal income tax return. They're used when the taxable income is quite low. A proprietor has unlimited liability risk related to the business, and they provide usually for pretty limited tax planning opportunities. This doesn't mean that they are not a useful tool, just that they have limited applicability. Partnerships are more complicated. They're often used when there is more than one business owner, and in proper circumstances, they can be a very effective planning tool. I'll discuss them a little more later. In many cases, corporations provide the shareholders with limited liability, which means there's a dividing line between the shareholders and the corporation, the corporate veil. The nature of corporations allows for much more tax planning. One of the best tools we have as Canadian tax planners is deferring income tax into the future. Using a corporation can be an effective deferral tool if the shareholder does not require all of the earnings from the business. For example, if a corporation earns $150,000 of taxable income, but the shareholder only needs $100,000 for personal living expenses, personal tax on $50,000 can be effectively deferred indefinitely. This can be used to expand operations of the business, invest corporately, or for mad money in the future. We recommend to all of our clients that they leave as much income as possible into the corporation. Business ownership. Assuming a corporation is being used, the next step is determining who will own the shares of the corporation. Will it be individuals, other corporations, family trusts, or some combination thereof? Generally speaking, the more income generated by the business, or the more value involved, the more complicated the corporate structure. These following slides are going to show some corporate structures that we often see. The first one is very basic and very common. We use this one quite often at the inception of the business, as it is easy for the shareholders to understand, and also allows for many different planning opportunities. The holdco-opco option is also very common. This one is useful when opco is generating a good amount of income. It can be moved up the corporate chain to holdco on a tax-free basis to purify and to creditor-proof opco. And I'll talk about that a little bit later too. This third option is often used when the business is intensively asset-based and is generating significant amounts of income and cash flow. Again, purity and creditor protection are important, but we also see this situation near the end of ownership of the business. For example, if there's a building involved that opco operates out of, but the current shareholders want to maintain ownership of after opco is sold to a third party, this structure allows the building ownership to stay with the original owners. Of course, there are a myriad of other options that are useful depending on the relationship between shareholders and their current and future objectives. It's also very important to point out that there are provisions in the Income Tax Act to change your corporate structure after inception and to do so on a tax-deferred basis. I also want to talk quickly about family trusts. We've seen a large increase in the use of family trusts in the last 5 to 10 years. These used to be the practice only of the super rich, but we've seen them now used by more common folk lately. They essentially give more flexibility in terms of remuneration and can also help in succession and estate planning. With respect to remuneration, a child over the age of 17 can receive dividends from a corporation owned by their parents if they are beneficiaries of a family trust that owns shares in that corporation. If the child is also going to post-secondary school, these costs can be paid for with dividends to the children rather than the parents taking the cash out of the company, paying tax on it at a much higher rate, and then giving it to the child. Obviously, this adds to the complexity of the corporate structure, but can be useful tool in the right situation. Now, with operational planning, once a business is underway and operations have commenced, there are many different planning opportunities. Some of these are simple and happen on an annual basis, and others are more complicated and are one-time events. So, remuneration. There are 3 main ways that we have our clients remunerate the owner of a corporation: salaries, dividends, and employee profit sharing plan, or EPSP. We use all 3 in different situations. Salary and EPSP are both taxed at the top marginal tax rate of 39%. Salaries are used when the shareholder likes to contribute to an RSP and wants to have the CPP available on retirement. I strongly believe in RSPs, but don't necessarily believe in CPP. This depends a little bit on what stage of life the shareholder is in. For example, if you're 55 years old, have not been diligent in saving for retirement, and are going to require the CPP benefits to pay for living expenses, then we would have the corporation pay you a salary so you can contribute to the CPP plan and maximize the benefits you receive. The main problem with salaries is that they're very tax ineffective, mainly because of the CPP that is paid by both the employee and the employer. I'll discuss this more when I talk about EPSPs. Dividends are the next remuneration option. In our practice, we most often see non-eligible dividends, which are taxed at approximately 28%. By definition, dividends are the payout of after-tax earnings of a corporation to the shareholder. Therefore, it must be understood that while the personal income tax rate is substantially lower for dividends, there has already been at least 14% corporate income tax applied to those earnings. Dividends can be effective when cash flow is tight for a new corporation because no remittances have to be made to CRA on a monthly basis. They're also effective when you already have plenty of RSP contribution room and are not worried about CPP benefits. We often use dividends in the first few years of a corporation's existence because of the cash flow benefits and to allow us to get a good understanding of how well the business is going to do. An EPSP is similar to salary, but allows you to not pay CPP. A husband and wife ownership team can save as much as $9,000 per year by using an EPSP. EPSPs create RSP contribution room and are very tax effective. However, there is some uncertainty about the future of this tool, as the Minister of Finance in the 2011 budget indicated that they're going to look at EPSPs to determine if there have been abuses to the rules. This has effectively put a freeze on new EPSPs in our office, but in certain circumstances we still use them. One of the first questions we get from most new clients is, can my company own my vehicle? My answer is usually, yes it can, but probably it shouldn't. Firstly, from a tax perspective, CRA does not like vehicles in corporations, and it is one of the first things that they look for in an audit. The rule is that if business kilometers are not at least 90% of the total kilometers driven, the vehicle should not be in the corporation. And even if it is greater than 90%, there are punitive standby and operating benefits that should be included in the shareholder's personal income each year. Therefore, we generally recommend that the vehicle be owned personally and that all expenses related to the vehicle, fuel, insurance, repairs, etc., be also paid personally. For every kilometer that is driven for the corporation, the shareholder gets a non-taxable allowance of 52 cents for the first 5,000 kilometers and 46 cents thereafter. This actually can work out real well for someone who puts a significant amount of kilometers on for business. If you put 60,000 kilometers in a year on your If you put on 60,000 kilometers in a year, your tax-free vehicle allowance will be approximately $29,000. We've done some work on this, and assuming you keep your vehicle for at least 4 years and put on a fairly reasonable amount of business kilometers, the allowance easily covers the capital and operating costs of your vehicle. We also provide a number of other allowances to our clients, which essentially get tax-free money out of the company, but provide a tax deduction. For example, overtime meal allowance works like this. If your normal work day is 10 hours, but you occasionally work 12 or more hours in a day, you're eligible for a tax-free allowance of $35 per instance. Like any other meal that is deductible to the corporation, this is subject to the 50% limitation. Certain expenses can have a business and a personal nature. As a shareholder, you want to maximize the business nature and minimize the personal nature. Golf memberships and golf fees and memberships are a very good example. For many business owners, golfing with employees, suppliers, clients, and potential clients is an important part of business growth. The Income Tax Act specifically disallows the deduction of golf fees and memberships, but because they are legitimate business expenses, they can be paid for by your corporation and are not considered shareholder appropriations and therefore are not taxed personally. This same logic applies to gym memberships, Cypress Club memberships, or any other organization that you're in the company of people that might impact your business. We recommend to our clients that all these types of expenses be paid for by the company and that are adjusted on the corporate tax return as non-deductible. If you're paying personally for life insurance, you should consider changing the ownership of that policy to your corporation. In most cases, the life insurance will flow through the corporation to the shareholder as part of the capital dividend account. It's important to understand that your intended beneficiary must coincide with the shareholders of your company upon your death. For example, if the beneficiary of your life insurance policy is your boyfriend, but your husband would have received the shares of the company on your death, this strategy will not work. This small business deduction allows corporations in Alberta to pay a marginal income tax rate of 14%. Active income above the $500,000 small business deduction is taxed at approximately 27%. It used to be very standard practice to ensure that you had no income above the small business deduction, and you would do this by bonusing any excess income to the shareholders. This has changed in recent years as corporate tax rates have dropped and the changes related to dividends paid out of the two levels of income, non-eligible and eligible dividends, have come into effect. Essentially, it's necessary to understand the client's current and long-term objectives to make a determination as to what to do about the small business deduction. Again, multiplying the small business deduction was a bigger issue in the past when it was only $200,000. Now that it's $500,000 for an associated group, we find it less of a problem. However, if you're in a business that generates significant income and want more access to that 14% tax level, there are ways to multiply the small business deduction. Essentially, operations must be split or partnerships must be used. The idea is to disassociate the corporations that are earning the income so that they both get access to that $500,000. Assuming that everything is done correctly and the proper agreements are in place, both branches of this partnership can be eligible for the $500,000 limit. This is a very complicated and risky area of practice and can be very effective in certain circumstances. Management fees form an integral part of the above planning. This is another area that CRA often looks at and is very sensitive to. As long as you have management fee agreements in place and they are legitimate business arrangements, we are of the understanding that CRA should accept them. As a general practice, we avoid the use of management fees to individuals because there usually isn't an agreement in place, and CRA can come back to the corporation and demand past due employee remittances as if the management fees were actually salaries or wages. One of the most important documents a corporation can have is a unanimous shareholder agreement, or USA. This is also one of the least used documents. Basically, a USA will dictate what happens if, for example, what happens to the corporation and the other shareholders if one of the shareholders dies or gets divorced or is criminally convicted of a serious offense. Do I want to have Ramey's wife as a 50% shareholder in my company if Ramey is convicted of income tax fraud? Probably not. The USA spells out, often in excruciating but necessary language, exactly what happens. For example, on the death of one shareholder, perhaps the life insurance goes into the company, is used to purchase the shares of the company from the estate of the deceased shareholder. The valuation method is also often discussed in the USA. If you have related or unrelated shareholders, you should consider a USA and talk to your accountant and your lawyer. So you've decided to get out of the business you've worked 30 years to build. You may have a child or grandchild who wants to take over. You may have a key employee that is interested in purchasing the business from you, or you might decide to put it on the open market and find a third party that will buy it. This will probably be the most important and most stressful part of your retirement. How do you maximize value and minimize income taxes? While every parent would love to have a child to transfer the business to, this is one of the most difficult areas of our practice. It's not a tax problem, but a people problem. Quite often, mom and dad are not really ready to give up the reins yet, and son or daughter feel that they've been driving the cart for the past 10 years. From a tax perspective, there are also issues. For example, how do we value the business? Any transfer between generations has to be done at fair market value, or CRA finds it offensive. More importantly, how do we do the intergenerational transfer tax effectively? And how is the cash flow going to work? Mom and dad may want all their money up front, which is going to put a huge strain on operating cash flow and or create a huge amount of tax ineffective debt. One plan we often implement is an estate freeze that works like this. Mom and dad are issued some form of preferred shares equal to the entire value of the corporation at that time. Now the common shares are worth a nominal amount and can be sold to son or daughter for $1. All future growth of the company accrues to these new common shareholders. Over time, the preferred shares are redeemed, which provides cash flow and income to mom and dad. This is very simplistic and requires an analysis of many different factors, including corporate cash flow, the age of mom and dad, the avoidance of old age security clawback, and the optimal share ownership from son and daughter. Another question that we hear quite often is, I want to sell my business. Should I sell the assets inside my corporation or the shares of the corporation? From the seller's perspective, it's usually better to sell the shares of the corporation. Firstly, this allows the seller to use the $750,000 capital gain exemption if the shares qualify. Selling the assets of the corporation creates two levels of tax. Firstly, the corporation will pay tax on any capital gain or recapture realized on the sale of the assets, and then the shareholder must pay tax if the money comes out of the corporation in the form of salary, dividends, or ETSD allocation. This can easily multiply the amount of tax owing on the sale. However, we probably see more asset sales than share sales. In fact, we're often asked to determine the tax difference so that this can be used in a negotiation. The main problem for the purchaser is that they do not want to inherit any hidden problems or liabilities inside the corporation, which they would do with the purchase of shares. If you are lucky enough to have the type of company that a sale of shares is likely, there is still substantial planning that can be done. Firstly, you want to ensure that the shares of the corporation qualify for the capital gain exemption. There are a number of rules here, but the main ones are that the company is pure, that it has at least 90% active business assets, and that you've owned the shares of the company for at least 2 years. With respect to purity, we use some of the share structures discussed earlier to help keep the company pure and to maximize the shares that might be subject to the capital gain exemption. We have to keep investments to a minimum in the operating company that is generating value. The second planning that can be done is multiplying the capital gains exemption. This is done by increasing the number of personal shareholders of a corporation and can be accomplished using a family trust, among other methods. There are two very specific but very punitive sections of the Income Tax Act that must be considered in all succession planning. Subsection 55(2) and Section 84.1 are anti-avoidance rules that must not be ignored. They are both very complicated and come into play in many different situations. All estate planning begins with the proper corporate structure and ensuring the maximum flexibility exists. A USA is a vital estate planning tool as it dictates what will happen on death. As discussed with succession planning, in order to take advantage of the capital gains exemption on death, the company in question must be pure. When you're going to sell a company, you can purify it in advance. Unfortunately, some of us don't know when we're going to die, so it's very important to keep the company pure at all times. This is extremely important with a company that has created a significant amount of goodwill value. Without going into any detail, there's a couple of post-death planning opportunities related to certain situations. The pipeline strategy helps to eliminate one level of tax on a holding company that has grown substantially in value, and the bump strategy provides a bump in the cost base of certain assets, usually land, in specific situations. Planned giving can also be a very useful tool, whether at death or during life. Donations provide one of the best tax credits we have. Every dollar of donation provides a 50-cent tax credit. However, if you donate securities on a prescribed exchange, any resulting capital gain is deemed to be zero. For example, as unlikely as it may sound, if you have shares of Synovus that have grown in value, you will get a full value of the shares as a donation credit and save 50% tax. As well, you will not be taxed on the resulting capital gain of that disposition. Obviously, life insurance is also a vital consideration if you have a substantial estate. This is a fairly complex area which should be discussed with your provider and your accountant. Often we are asked to estimate the income tax liability on death so that someone can insure that amount so the entire estate can transfer to the next generation. Another serious problem that can arise is this. Assume you have a company that is worth a substantial amount that will continue to be operated by your children on your death. You will have a substantial tax liability on your death, but there may be no cash to pay that tax. Life insurance can be used very effectively to ensure that there is cash available. A minor tool that we often advise our clients on is the death benefit. $10,000 can be paid tax-free from your corporation to your spouse on your death. None of the above plans or tools can be applied in a vacuum. They're often impacted by other tax plans and issues and must be analyzed in the greater scheme of things. As mentioned earlier, the tax tail should not wag the dog. That being said, proper planning is vital to business growth and maintaining retirement and estate value. Most of these plans cannot be retroactively applied, so it's important to be constantly in contact with your professional team. Now, Randy Foussant from our office is going to discuss the importance and interpretation of financial statements. Thanks for your time.
Thanks, Dan. Well, ladies and gentlemen, Dan mentioned, my name is Randy Poisson. I'll be spending about the next 20 minutes discussing how financial statements can be used to maximize the profits of your business. To start off with, I've been told that involving your audience is an excellent way of obtaining buy-in to your subject matter. I've also heard that it's a good way to calm the nerves of the presenter, which is a good thing, because picturing all of you in your underwear is not working for me. As a rough classification, I would like to break the typical financial statement user into three main categories. The first are high-level users. These users use financial statements on a daily basis and would consider themselves to have high technical understanding of how the different financial statements interact with each other. The next level is moderate-level users. These would be individuals who understand financials, but at the 10,000-foot level. They know what all the key aspects of the income statement and balance sheet are, such as AR, cost of sales, just to name a few, but don't regularly analyze their financial statements to explain variances in the operation of their business. And finally, we have low-level users. Low-level users will often shy away from financial statements because they don't understand them. They know what some of the components of the financial statements are, but essentially have financial statements prepared for someone else's purposes. As a quick show of hands, who here feels that they're a high-level user? Moderate-level user? Low-level users? Your business. Let's start off by thinking of your business as its own entity. The purpose of this entity is to meet the needs of the market which it serves, and by doing so, survives and thrives. The more efficiently it does this, the more profit it can make. So how can we know how this entity is doing? Well, if we think about your business as a living person, then the financial statements will be used to describe the health of that person. The balance sheet would describe the body, the general appearance of the company, and things like the bones and muscles of the company, or the resources the company has at its disposal. The income statement would describe the health of the company. High blood pressure or cholesterol akin to poor inventory turnover or losses in the year. And finally, we have the cash flow statement. The cash flow statement describes the flow of cash, which is the lifeblood of any entity. Where it comes from and where it goes. And it also helps us assess the correct amount needed to keep your entity alive. Now that we have the core concept down, let's apply it to my fictional company. Just to bring everyone up to the same basic level, I'll quickly go through the three main financial statements previously described, identifying their components. I will not be attempting to squeeze an introductory or advanced level accounting class into this short 20-minute session. What I hope to do is to use my fictional company as a tool to analyze my conceptual purpose of financial statements, which describe what is happening with your company. Well, we've probably all seen this. Statement of income. The very top line there is the revenue. That's, of course, what you're selling. The next line, your cost of sales. These are comprised of the direct costs associated with the product you are selling. They are usually variable items such as purchased goods, direct labor, and freight, to name a few. Tried to get fancy with the laser pointer, it didn't quite work for me. The next line is the gross profit. This is the incremental profit generated from the sale of each of your goods or services. Below that is expenses, or general expenses. These are usually comprised of indirect costs and can take the form of both variable and fixed. They form the nut that the company must crack each year in order to turn profit. Your net income or loss at the bottom is really the addition of net assets obtained by the company over the last year. The profit is stored on the balance sheet as a reduction of liabilities or an increase of assets. Profit, of course, does not always mean cash, as profits can be held as increases in AR or inventory. Next, we have the balance sheet. The balance sheet is comprised of three key sections: assets, liabilities, and equity. Some of the assets and liabilities are current and some are long-term. As their name suggests, current designates assets or liabilities which will be converted to cash and settled within the next year. Long-term means the settlement date is sometime in the future. True to its name, the balance sheet must balance. So all of the company's assets, less its liabilities or obligations, equal the value of your company or its equity at any given point in time. Lastly, we have the statement of cash flow. As we all know, cash is king, and as previously mentioned, the lifeblood of our entity. Cash flow seems to be the common denominator for business owners, though people will often be unable to see the connection between net income and end-of-year cash. This statement is an excellent way to reconcile how the company can go from a profit to a reduction in cash over the same period. The cash flow statement breaks it down in a few simple steps. To start off with, we start off with net income. Below that, we have cash flow from operations, which is just for non-cash items. How much cash entity generated in the year from selling its goods and services. Net change in working capital is next. This is how much cash was gained or lost due to changes in the current assets and current liabilities. Did you collect from all your clients? Did you pay all your suppliers? Investing activities is next. What long-term assets did we purchase with our cash? And finally, financing activities. How did we cover any cash shortfalls in the year? Next, I'd like to take my conceptual understanding of financial statements and apply it to a common scenario of businesses of all sizes, the purchase of a building. In reality, the analysis of obtaining financing and analyzing the purchase of a building occur at the same time. For presentation purposes, I have chosen to look at the financing analysis from the point of view of the banker, followed by the analysis of the business plan from the point of the owner. The first ratio bankers will usually look at is the current ratio. The purpose of this ratio is to test the ability of the company to meet its short-term financial obligations. Of course, that's just a technical definition. What this ratio is really looking at is the ability of your business to operate in the short term. Will you have the ability to buy the supplies and inventory, pay your employees, and continue to collect the amount owing to you in the short term? By doing this calculation, the bank is deriving comfort on one of its two key areas of risk. Will I make money from this transaction? The only way the bank will make money is if your company can make the interest payments. Banks usually like to see this ratio at about 1.25 to 1. In the case of my Nuco example, this ratio is handily met at 6 to 1. The second ratio is debt service coverage. This ratio is pretty true to its name. The sole purpose of this ratio is to ensure that the entity can cover its annual debt payments. The source of the data is pretty self-explanatory. Your after-tax net income divided by the total debt payments in the year, which are comprised, of course, of interest and principal. The bank likes to see this ratio at no lower than 110%. What the bank is really doing here is analyzing their second area of risk, the risk of the investment today. Will they get their money back? Keep in mind that even though the bank is combing the financial statements, looking at specific ratios, they are still looking at the larger entity. How well is this entity structured? Are its operations healthy? How is its cash position? They do a high-level analysis and then delve into the areas of concern and analyze the reasons for the problem. As a further reduction of risk, a steady history of earnings over many periods will demonstrate the stability of your business. The more volatile the business, or the shorter the history, the greater the risk associated with the debt, which could result in higher debt covenants than listed above, or even the inability to obtain financing. The relative profitability of your business is also a general item which banks will look at. They may look at your financial statements and see a moderately profitable business. Upon further review, they may see several expense items that could be subject to high variability at your cost, such as fuel prices. These costs could quickly turn a moderately profitable business into an unprofitable business in the short run. This is another reason why several years of financial history can prove to calm the nerves of jittery lenders. Let's take a quick look at the analysis of the rental business from the owner's standpoint now. The bank said yes, but just because the bank said yes, doesn't mean this is the best time to pursue the purchase of a new building.